why not do it all? Why not take advantage of it? Every nook and cranny that the IRS offers. There's 6 different ways to get money into tax-free buckets. Why not do them all?
So you can do a Roth conversion of any amount from your IRA 401k to a Roth IRA. You can still make a contribution. That's where there's some limits on income and those kinds of things, how much you can contribute. But then the conversions, any amount. So people can start doing that. We're talking about other things. We're looking at IRMA or looking at Medicare, what your income is that would affect that. You're looking at your tax bracket. So let's say conversion off the table. Now someone says, okay, now I need to get the rest of my money into things that are tax-free. I can convert. Now I have this maximum contribution. If I'm over age 50, it's $8,000 per person, $16,000 per couple. Let's say that I've maxed that out. Into putting something that's tax-free and or maxed out in my income. I can't put it in there. What other options does someone have where they can get literally 100% federal, state, tax-free income from their investment account or product?
Well, I talk about 6 different streams of tax-free income, so I'll fly through them real quickly. You got your Roth 401k, you can put up to $31,000 in there. You got your Roth IRA, you can put $8,000 in there. You got Roth conversion, you can convert unlimited amounts. You can leave some money in your IRA at retirement because your required minimum distributions can be offset by your standard deduction. Remember, so you can leave some. So that's to me, that's the holy grail of financial planning. Because you got a deduction on the front end, it grew tax deferred. You took it out tax free. You got something we talked about last night called the LIRP, the Life Insurance Retirement Plan. There's no limits on how much you can put into that. There's no income limitations. You get a death benefit that doubles as long-term care. You can get that death benefit in advance of your death for the purpose of paying for long-term care. And should you die peacefully in your sleep 30 years from now, never having needed long-term care, someone's still getting a death benefit, probably your kids or your grandkids. And then if you can keep your provisional income low enough, and remember, provisional income is the income the IRS tracks to determine if they are going to tax your Social Security. If you can keep that low enough, then your Social Security is also tax-free. So I like to tell people, hey, if you have tax-free, 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 what tax bracket does that put you in? 0%. Why do we like 0? Because if tax rates double, 2 times 0 is still 0.
Absolutely. That's right. And I love that formula, and that's really the crux of the matter. And I want to come back to that in just a minute. But then, so this LIRP, life insurance. So we're talking about a permanent policy. But the kind of how it works is you're paying for insurance. You're paying like for term insurance, 100 or 120. So you're buying a death benefit, but then you can overfund it. The IRS says you can overfund this policy. The portion that's overfunded is what's growing tax deferred, and you can take out tax free.
Yeah. So I tell people, think of it in terms of a bucket of money. You put money in. As your money grows, your bucket begins to fill. And by the way, that money is growing safely and productively. You're not going to hit home runs like you would in the stock market, but you might get 6 to 8% gross of fees, 5 to 7% net of fees over time. So it's a great bond alternative. So your money is growing safely, productively. But as your money grows, you have all sorts of benefits that accrue to you. You can touch that money pre-59 and a half. Like I said, there's no income limitations, no contribution limits. I got clients that do $200,000 per year into these buckets. And again, the cost of admission is you got to be willing to pay for some life insurance. You got to have a need for life insurance. But the good news is, hey, if you're getting to the point in life where you don't think you need life insurance, that life insurance also doubles as long-term care. In other words, these companies are willing to give you your death benefit in advance of your death for the purpose of paying for long-term care, which is a great alternative to traditional long-term care insurance, which gives people heartburn because it's a use it or lose it proposition. You're paying for something you hope you never have to use. And at least in this way, you die peaceful in your sleep, 30 years from now, never having needed long-term care. Someone's still getting a death benefit, probably your kids or your grandkids. So there's that sensation of having paid for something you hope you never have to use.
So it solves a lot of issues, solves a lot of problems. I like the idea of the cost of admission. I was thinking last night when you're talking the cost of admission is converting your IRA to a Roth IRA, paying the tax. But there's also a cost of admission to get into the life insurance retirement plan, and it's the cost for the insurance. You have to pay something to get something back tax-free. But in this case, the benefits far outweigh that. I guess the advantage of the Roth conversion is there's no medical underwriting, or at least with the LIRP, there's still some medical underwriting.
Right. You got to qualify. It's the life insurance companies are like odds makers in Vegas. They're in the business of predicting how long you're going to live. They want to make sure that you don't die in the first 10 years. Because if you die in the first 10 years, it's a really bad deal for them. Great deal for you and your family. Bad deal for them. So they send you through an underwriting process, and they just want to make sure that you're going to live like a normal, healthy, length of a life. And if you do, then they will extend you an offer.
Yeah. In your experience with people who are doing the LIRP and we're buying life insurance for tax-free income in the future, it has all these other benefits, long-term care, death benefit, those kinds of things. Is there a time frame that people need to make those premiums? Is it a single premium? Is it a 5-year premium? Is it 10 years? Is there a sweet spot for funding one of those?
Yeah, I'd say 5 to 7.
5 to 7.
It's this whole idea of time value of money. You want to get the money in there as quickly as you can, as quickly as the IRS will allow you to. There are constraints on how quickly you can put it in there, but 5 to 7 years, if you can stuff as much money as you can into those programs, and then all of that money gets to work for you early on in life versus stringing those contributions out over a long period of time, and then the money's not quite as productive.
Yep. There's some people that are out there that say that's all that someone should do. No one should do Roth IRAs. No one should.
It gives me the willies.
In other words, some people with all or nothing, man, you should do all Roth IRAs, never touch life insurance. There's those people out there. Then some people that say, hey, never touch your Roth IRAs or the stock market. You should only be doing life insurance.
Yeah. I mean, I can't think of any financial malpractice worse than that. I really advocate for an approach that calls for taking advantage of every nook and cranny in the IRS tax code. Why not do it all? Why not take advantage of every, like I said, every nook and cranny that the IRS offers? There's 6 different ways to get money into tax-free buckets. Why not do them all?
Yeah, absolutely. And you mentioned in the book, The Power of Zero. And so the formula, I just want to make sure it's clear to everybody, the formula to get to a zero tax bracket in retirement would be, and the first one's the one that I think the first time that I heard you speak was the most eye-opening to me because I never really think about it. It's like, hey, let's convert all your money from IRAs to Roth IRAs. The first one is, well, no, you can leave some money in your IRA, only leave enough to get you to the standard deduction. Take that withdrawal, $30,000, whatever it is. It's taxable, but then you get the deduction, which you can deduct that income.
Yeah. So this is what I tell people. I say, you want to, and this is the number one mistake I see people make when it comes to doing Roth conversions. I say, I got $1 million in there. The tax train is coming. I'm going to convert it all. And they do it blindly, willy-nilly, haphazardly. If you're married, you don't have a pension or other source of residual income, you want to leave about $350,000 in there because that will produce an RMD that is equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. So that it's about half that amount if you're single. So there is a what I call a magic number that you should have in that bucket. And again, you can't figure out what that magic number is for your particular situation unless you're working with an expert like you guys.
Absolutely. So I like that. I mean, keep a certain amount in there. Don't convert all of it because then you are paying a tax that you would not have had to have paid.
That's exactly right.
So that's the first one. Then obviously there's Roth IRAs. Well, I mean, most people at this point hopefully know that we have the 5-year rule, but hopefully all of your contributions, all the earnings in the Roth IRA post 59.5 after 5 years, 100% income tax free. So if you can get a lot of income from there. And then maybe you have this life insurance, the retirement plan where you can draw money from those accounts, 100% income tax free. And ideally when you have, like you said, standard deduction, a taxable amount that's deducted from the standard deduction, you've got Roth IRA income, you got life insurance tax free income, you have no income. So all your Social Security is going to be tax free too. And there you go. You've got it.
Yeah.